Hello everyone, Professor Christensen here. This video is going to take a look at adjusting entries, all about adjusting entries. Adjusting entries are often problematic for students. So I'm hoping that this will help you in your accounting studies. All right, so today's agenda is we'll take a look at what are adjusting entries, why we need them. Then we're going to talk about some important tips that will help you when making adjusting entries. And then we'll do some specific examples that will walk us through some common deferral and accrual accounting adjusting entries. All right, so the accounting cycle. Let's remind ourselves, we want a little context. What is this all about? Why are we making adjusting entries and what are they? So let's recall what happens in the accounting cycle. So remember, a transaction happens, right? And let's say the company buys some supplies on account. So you make a journal entry. You debit supplies and credit accounts payable. You post that journal to the ledger. Why? Because you want to know how much your supplies are and how much your accounts payable are. And then you have a trial balance, which is a list of all of the accounts and their current balances. Very handy to have, right? All right, so then what happens is at the end of the period, we have to deal with these adjustments. So we're going to make the adjustments and we're going to post them. And that's going to be a second trial balance. That's going to be our adjusted trial balance. Very important because the adjusted trial balance is how we prepare our financial statements. So basically what we're doing is we're cleaning things up. We're recording things that need to be recorded so that we are ready to prepare our financial statements. All right, why do we need adjusting entries? Well, there's a couple of things. First of all, some transactions occurred during the period, but they haven't been recorded yet. So for example, your employees earn salaries, right? So almost every company is going to owe salaries at the end of the year. Why? Because you don't pay your employees on the last day of the year for everything you owe them, right? So that has to be recorded in your books because you want to show the expense on your income statement and you want to show the liability on your balance sheet. The other thing is that there are a lot of activities that occur every day, but of course they're not recorded every day. So for example, the company could be using supplies, earning or accruing interest. So maybe they borrowed some money. Every day they are accruing more interest on that debt, right? But they're not going to pay it maybe for another year or however many months. So the interest needs to be included in your financial statements, okay? And rent expiring is another example. Every day, if you pay for your rent ahead of time or you pay for your insurance ahead of time, you're using some of it up, but you're not going to record that every day. All right, so some little bit more specific examples, and then we're going to really get into the details. So, for example, cash is paid for 1 year for rent on January 1st. And we're preparing financial statements at the end of the first quarter, which is March 31st. So what has happened, some of the rent has expired, right? So we have this prepaid rent, which remember is a current asset on your balance sheet, but some of the prepaid rent has expired. So we need to prepare an adjusting entry, okay? This is called a deferral. So with deferrals, cash comes first and the revenue or expense is recognized later. So on January 1st, we recorded the cash that we paid for our prepaid rent. And then on March 31st, we're going to recognize the rent expense. All right, so remember with the deferral, cash comes first and the revenue or expense comes second. All right, another example is let's go back to the salaries. So salaries have been earned at the end of the period, but they're not going to be paid until next month. But we're preparing financial statements at the end of March. All right, so what do we need to do? We need to record the unpaid salaries, like I just mentioned, and then they're going to get paid next month. Now, this is called an accrual. An accrual means that your revenue or expense is going to happen first. So right now, we have to record our salaries expense, right? Because we owe our salaries payable. We owe our employees salaries, and they have earned those salaries this period. We're not going to pay them until next period. So the expense happens now, the cash happens next period. Okay? So the accrual is this adjusting entry at the end of the period. All right, so important tips about adjusting entries, and these will help you. These are like general rules for adjusting entries. Remember that they happen at the end of the accounting period, and they're needed to fix our financial statements up to get them ready for, fix our accounts up to get them ready for their financials. Every adjusting entry affects one balance sheet account and one income statement account. So that means you're going to hit either an asset or a liability, and you're going to hit either a revenue or expense. Okay, so if you have one, then maybe you know that, so for example, if you have a salaries payable, you know that's a liability. That means you're looking for a revenue or an expense account. Okay, finally, no adjusting entry affects cash. I tell my students that when you're doing adjusting entries, cash is a 4-letter word. It's a bad word. Don't use cash in adjusting entries, okay? Now, don't be afraid to debit or credit cash any other time, but when you're doing adjusting entries, no cash. Okay. All right. So let's take a look at some examples. We're going to look at 3 common deferrals, and these are the kinds of entries that you will typically see in your financial accounting class. So we're going to look at supplies, and then we're going to look at prepaid rent. Prepaid rent and insurance work the same way, so you can use the same principles for both of them. And then we're going to take a look at deferred revenue. All right, let's get into the details. So, supplies expense. So, a company buys $1,500 of supplies for cash on January 1st. At the end of the month, financial statements are being prepared. So, remember, you can prepare financial statements monthly, quarterly, every year. In this case, it's the end of the month. It's found that only $500 of supplies remain, so $1,000 of the supplies were used up during the period. All right, so what do we have to do? Well, first of all, remember with adjusting entries, they require you to think and to analyze. Okay, so that's the thing that gets students. You have to think about what's wrong and what's right and what needs to be fixed. So now remember I said don't debit or credit cash, but this is not an adjusting entry. Okay, this entry here is the entry that you made when you bought the supplies. So on January 1st, you bought the supplies, you paid $1,500. Now, this is our adjusting entry. AJE stands for adjusting entry. We're going to record the amount of supplies that we used up, right? What happened? We used up $1,000 of supplies. So remember, supplies is an asset account. It has a debit balance. So instead of $1,500, we have to reduce it by $1,000 because we used up the $1,000, and we call that supplies expense. Here's our income statement account. Here's our balance sheet account. All right, what's going to be on our financial statements? Well, we're going to have supplies of $500 as a current asset, right? Because that's what's left. We have $500 left. We debited $15. We credited $1,000 because we used it. And then on our income statement, we're going to show supplies expense of $1,000. Okay? So supplies is an example of a deferral. All right, another deferral, prepaid rent example. Company paid $12,000 for 1 year's rent on August 1st. Now, remember to watch your dates and rates. I tell students dates and rates. Those are the things that are going to give you trouble, all right? So at the end of the year, so they paid $12,000 August 1st. At the end of the year, financial statements are being prepared. Now, notice that it doesn't tell you what you have to do. That's one of the problems with adjusting entries. A lot of times, you'll read in a textbook and it'll just say a company paid $12,000 for 1 year's rent on August 1st. Financials are being prepared December 31st. They don't tell you what you have to do. So you have to figure it out, right? So what happened? Some of that was used up, right? So on August 1st, here's our entry that we made. We debited prepaid rent for $12,000 and we credited cash for $12,000. Now, at the end of the year, we have to record the rent that we used up, the prepaid rent we used up. Now, how much rent did we use up? Again, this is our adjusting entry. Notice there's no cash here. There is an income statement account. There is a balance sheet account. All right, where did we get these numbers from? Hold on to that financials for a minute. So what happened? August, September, October, November, and December have expired. 5 months have expired, and 7 months are still prepaid. How much do we use up every month? Well, we pay $12,000 for 12 months, so we use up $1,000 a month. All right, so that's how we got this $5,000. 5 months at $1,000 per month, we used up $5,000. Now, what's left on our financials? All right, again, we have the asset of $7,000 because we started with 12, we used up 5, and we have 7 left. And 7 months are still prepaid, right? 7,000. So we have a current asset of $7,000 on our balance sheet, and our income statement shows rent expense of $5,000. All right, so that is prepaid rent. One more deferral example. Let's look at deferred revenue. So when you have deferred revenue, what that means is that a customer paid you for something that you have not yet given them. So they paid you for goods or services that you have not yet delivered. So what does that mean? That means that your company has a liability, and that's what deferred revenue is. All right, so let's see what we have here. A snow plowing company receives $35,000 on September 1st for services it will provide evenly from October 1st to April 30th. Financial statements are prepared at the end of the calendar year. So here we're preparing financials at December 31st. All right, this is particularly tricky because we're getting the money on September 1st, but we're not earning any money until October 1st, right? So what period of time are we earning revenue here? October, and I always tell my students, count on your fingers. Don't be afraid to count on your fingers. October, November, December, January, February, March, April, 7 months, right? So we're gonna, that $35,000, we are earning evenly over 7 months. All right, let's look at the entries. So on September 1st, we got $35,000 in cash. We credit deferred revenue. This is the liability that we have to our customers. We owe them snow plowing services, right? Now at the end of the year, how much of that have we earned, right? How much of that liability have we discharged? Well, here's our adjusting entry. Debit deferred revenue, that's a liability or a balance sheet account, and credit your service revenue, that's your income statement account. All right, so what did we do? Each month, the company earns $5,000 because we got $35,000 for 7 months. So that is $5,000 a month. 3 months have been earned because remember, we started in October, right? We're going to provide the services October 1st to April 30th. All right, 3 months have been earned, October, November, December. So that's $5,000 times 3, or $15,000 has been earned. Okay, and we had 7 months altogether, so that means 4 months are still unearned. So at the end of the year, what do we end up with? Well, we had deferred revenue of $35,000. We debited that liability because remember, liabilities have a credit balance, and we debited the liability to reduce it. And our new liability that goes on our balance sheet is $20,000, and that is a current liability. Our revenue is $15,000. Okay, so those are our deferrals. Now let's take a look at some common accruals. We're going to look at salaries expense, interest expense, and accrued revenue. All right, remember I said salaries expense. Almost every company is going to have accrued salaries at the end of the year. So let's look at this company. They pay their employees every Friday $5,000 a week for working Monday through Friday, but the year ends on a Tuesday. All right, so what happens? So we pay all of our employees $5,000 per week, Monday through Friday. All right, so what happens? Each day, employees earn $1,000, right? Because we pay them $5,000 for 5 days. So at the end of the year, the company owes $1,000 times 2 days, or $2,000. So let's look. I think it's easier to look at a little picture of a calendar here. So the last 2 days of the week, remember the year ends on Tuesday. So here we are here, Tuesday's December 31st. So employees earned $1,000, $2,000 in year 1. That's the year that we're accruing for. And then they earned $3,000. They're going to earn $3,000 next year. Okay? So our adjusting entry at the end of the year is for $2,000 because we owe $2,000. So debit salaries expense, credit salaries payable. Anytime you have accrued expenses, you're going to be debiting an expense and crediting a payable. So that's going to help you. It's like a pattern. Debit expense, credit payable. All right. Now, this entry, it's not really required. This is not our adjustment. This is our adjustment here. But just so that you could see, next year when we pay them, which will be on Friday, we're going to debit the payable that we recorded last year. So here's the $2,000. We're going to debit salaries expense to record this year's expense of $3,000. And then we credit cash of $5,000. All right. So our employees are paid. All right, now let's take a look at another expense. Let's look at interest expense because many companies have interest expense, right? If you have any kind of a loan, you're going to have interest expense. Okay, so a company borrowed money by signing a $10,000 one-year note payable on November 1st. The note bears interest at 3%. Remember dates and rates. November 1st, 3%, we borrowed $10,000. Okay, so what is happening? At the end of the year, remember debit expense, credit payable, we owe $50. Let's see where that came from. All right, so interest is principal times rate times time. So our principal, we borrowed $10,000, 3%, 2 over 12. Remember that time is in terms of a year. So there were 12 months in the year, and we owe interest for 2 months, or $50. All right, let's look at it here. So every month, if you turn this into a 1, right, 10,000 times 3% times 1 over 12, you're going to get $25. So every month, we owe $25 of interest. So at the end of the year, we owe $50, right? Now, this is a year loan, so we're going to have to pay the rest of the interest is going to be accrued next year. So we're going to record the expense for that next year. So the end of the year, debit interest expense, credit interest payable. Remember debit expense, credit payable for $50. The interest expense is our income statement account. Interest payable is a current liability on our balance sheet. And next year, so the loan will mature on October 31st. We're going to debit the interest payable. Again, this is from here, right? We're going to debit interest expense for the interest that pertains to that year, the second year. And then we're going to debit the note payable because we're paying it off and we're crediting cash for all of that. Okay? So at the end of the note, when the note is paid off, this is the journal entry that we're going to make. Again, that's like a bonus because remember, we're just looking at the adjusting entry here at the end of the year. All right, let's take a look at accrued revenue. So services in the amount of $3,500 were performed for customers in the last couple of the days of the year, but they haven't been billed yet. In January, the customers are going to pay their bills. All right, so this one's kind of simple. We perform services, they haven't paid us, we haven't billed them yet, so what do we have to do? We have to debit accounts receivable and credit service revenue for the money they owe us. Now, next month, we pick a random date, the 21st, they're going to pay us. So next month, we're going to get the cash and credit the accounts receivable. So anytime you have accrued revenue, you're going to be debiting a receivable and crediting the revenue. All right, so our financials are going to show an account receivable as a current asset, and then our revenue on our income statement will be $3,500 more as a result of that journal entry. All right, so to review, today we looked at adjusting entries. They're prepared at the end of the period in order to update the accounts. Every adjusting entry affects one income statement account, a revenue or an expense, and one balance sheet account, an asset or a liability. They never affect cash. They do require an analysis, which is why sometimes they give students trouble. And don't forget, watch your dates and your rates. All right, that's all we have for today. Happy accounting. If you enjoy my videos, please subscribe below, and I'll see you next time.